I've watched thousands of investment decisions over the years, and here's what I know for certain. The biggest losses don't come from market crashes. They come from investors who change their strategy every time they read a headline. This is a fan-made educational episode. Some narration may be AI generated and is not the real voice or statements of any individual. Today, I'm going to share 5 simple rules that can save your portfolio from the most expensive mistakes investors make. These aren't predictions about what the market will do next. These are operating rules that work regardless of what happens. And by the end of this episode, you'll have a complete system that removes emotion from your investment decisions. Most people think successful investing is about picking the right stocks or timing the market perfectly. They believe if they can just predict what happens next, they'll build wealth. So they chase hot sectors, panic during corrections, and constantly adjust their strategy based on the latest news cycle. They switch from growth to value, then to international, then back to domestic based on whatever performed best last quarter. But here's what that approach actually costs you. Every time you change course, you're interrupting the power of compounding. Let's say you have $500,000 invested. If that grows at 7% annually for 20 years without interruption, you'd have $1,935,000. But if emotional decisions cause you to miss just 2% of annual returns through bad timing and strategy changes, you'd end up with only $1,485,000. That's a $450,000 difference, nearly $500,000 lost to reactive decision-making. And here's the part that really stings. That missing 2% doesn't come from one big mistake. It comes from dozens of small adjustments. Selling after a 10% drop and buying back 5% higher. Switching strategies after a bad quarter, adding money during rallies instead of declines. These small moves compound into massive wealth destruction over decades. The solution isn't better predictions, it's better rules. Here are the 5 rules that prevent million-dollar investment mistakes. Rule number 1. Set maximum position sizes. Never let any single investment exceed 10% of your portfolio, regardless of how confident you feel about it. Why does this matter? Because confidence kills portfolios. When an investment does well, it grows larger. Without limits, it can become 20%, 30%, or even 50% of your portfolio. Then, when it crashes, it takes your entire financial future with it. Here's the math that makes this clear. If a 40% position drops 50%, that's a 20% portfolio loss. Recovery from a 20% loss requires a 25% gain just to break even. But if that same investment was limited to 10% and dropped 50%, your portfolio only loses 5%. Recovery time drops from years to months. The difference between a 5% loss and 20% loss isn't just the immediate pain, it's the years of compounding you lose while recovering. Let me give you a real example. If you had $800,000 invested and let one stock grow to 35% of your portfolio, then it crashed 60%, you'd lose $168,000 in one position. But if you'd kept it capped at 10%, that same crash would only cost you $48,000. The $120,000 difference could represent 3 to 4 years of retirement income. Action step. Calculate your current largest position. If it's over 10%, sell enough to bring it back to your limit. Set alerts to rebalance when any position hits 12%. Don't make exceptions for sure things. There are no sure things. Rule number 2, define your cash policy. Always maintain 6 to 12 months of expenses in cash and deploy excess cash using dollar cost averaging over 6-month periods. Cash serves 2 purposes: emergency buffer and opportunity fund. Too little cash forces you to sell investments during downturns. Too much cash creates opportunity cost that compounds over decades. The numbers work like this. 6 months of expenses at $8,000 monthly equals $48,000 in cash. Anything above $48,000 gets invested systematically. If you suddenly inherit $100,000, you'd keep your $48,000 buffer and invest the remaining $52,000 over 6 months at roughly $8,700 per month. This prevents you from investing everything at the market peak. Here's why the systematic approach matters. If you invest $50,000 all at once and the market drops 20% immediately, you're down $10,000. But if you dollar cost average that same $50,000 over 6 months during a declining market, you actually benefit from the volatility. Lower prices in months 2 to 6 reduce your average cost basis. Action step: calculate your monthly expenses and multiply by 6. That's your cash floor. Set up automatic investments for any excess above this amount. Use a high yield savings account for your cash buffer so it's not earning zero while waiting. Rule number 3: use trigger based rebalancing. Rebalance when any asset class drifts more than 5% from your target allocation or every 6 months, whichever comes first. Most people rebalance when they feel like it or when markets seem scary. This guarantees you'll buy high and sell low because feelings follow market movements. Trigger-based rebalancing forces you to sell what's expensive and buy what's cheap. If your target is 60% stocks and 40% bonds, but stocks run up to 68%, you automatically sell 8% of stocks and buy bonds. This captures gains during good times and positions you for the next cycle. The math here is powerful. Studies show disciplined rebalancing adds 0.3% to 0.7% annually to returns. Over 25 years on a $600,000 portfolio, that's an extra $200,000 to $400,000. You're literally getting paid to be disciplined instead of emotional. Action step: write down your target allocation percentages. Set calendar reminders every 6 months to check drift. Create sell orders when any category hits plus 5% above target. Use tax-advantaged accounts for rebalancing when possible to avoid tax consequences. Rule number 4: implement risk stops. If your overall portfolio drops more than 20% from its peak, reduce equity exposure by 10-20% temporarily until markets stabilize. This isn't market timing, it's damage control. The goal isn't to avoid all losses, but to prevent catastrophic ones that take years to recover from. Here's why it matters mathematically. A 50% loss requires a 100% gain to break even. But if you limit losses to 25% through systematic risk management, you only need a 33% gain to recover. The difference in recovery time can be 3 to 5 years. For someone in their 60 seconds, that's the difference between financial security and running out of money. Consider this scenario. Your $750,000 portfolio hits an all-time high, then starts declining. At 10% down, you're watching closely. At 15% down, you're getting nervous. At 20% down, your rule triggers. You reduce stock exposure from 70% to 50%, moving $150,000 to bonds temporarily. If the market falls another 20%, your total loss is 32% instead of 40%. That's $60,000 saved in this example. Action step: track your portfolio's all-time high value monthly. When it drops 20% below that peak, reduce stock exposure from your normal allocation to a more defensive position. Resume normal allocation when markets recover 10% from the low. Rule number 5: schedule reviews, not reactions. Check your portfolio monthly for rebalancing needs, but only make strategy changes during quarterly reviews with a 30-day waiting period. Daily portfolio checking creates two problems: overconfidence during good periods and panic during bad periods. Both lead to expensive mistakes. Monthly checks handle tactical needs like rebalancing. Quarterly reviews handle strategic questions like allocation changes. The 30-day waiting period prevents emotional decisions. If you want to change strategy, write it down and revisit in 30 days. Most urgent changes aren't urgent after reflection. Here's what this prevents. During the COVID crash in March 2020, portfolios fell 30% in 3 weeks. Investors who checked daily panicked and sold. Those who stuck to quarterly reviews rode out the storm. By August 2020, markets had fully recovered. The daily checkers lost money. The quarterly reviewers made money. Action step: set monthly calendar alerts for rebalancing checks. Set quarterly alerts for strategy reviews. Create a simple checklist for each review type so emotions don't drive decisions. Keep a decision journal to track what you wanted to change and why. Most ideas won't seem urgent after 30 days. Now let's talk about the 3 most expensive mistakes these rules prevent. First, changing your strategy after every headline. Markets are always uncertain. Headlines are always scary. If you adjust strategy based on news, you're guaranteed to buy high and sell low. The media makes money from your attention, not your returns. Second, letting winning positions become too large. Today's best performer often becomes tomorrow's biggest disaster. Position limits prevent single investments from destroying your portfolio. Remember, diversification isn't about owning different things, it's about owning things that don't all fail together. Third, rebalancing whenever it feels right instead of using systematic triggers. Feelings follow market movements, which guarantees bad timing. When stocks are soaring, you feel confident and don't want to sell. When they're crashing, you feel scared and don't want to buy. Rules force you to do the opposite of what feels natural. Now here's what to do next. Write down these 5 rules on one page where you can reference them easily. Set your maximum position size at 10% and rebalance anything currently above 12%. Choose your rebalancing triggers, either 5% drift or 6-month intervals. Define your cash policy by calculating 6 months of expenses as your floor. Set your review cadence with monthly rebalancing checks and quarterly strategy reviews. Define what data actually matters for decisions and ignore everything else. Finally, commit to a 90-day period where you follow these rules without changes, regardless of what happens in markets. Let me recap the core system. First, position limits prevent any single bet from becoming your entire portfolio. Second, systematic cash management ensures you have opportunity and security without excess drag. Third, trigger-based rebalancing forces you to buy low and sell high automatically. Fourth, risk stops prevent catastrophic losses that take years to recover from. Fifth, scheduled reviews prevent reactive decisions that interrupt compounding. Remember, this is educational content only. Always verify specific strategies with official sources like SSA.gov and consider consulting professionals for your specific situation.